You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by my co-host John McEwen, and it's the 29th of June 2025. And in this week's episode, we'll be discussing Tesco, Safestore, Carnival, Moonpig, Bunzl, and our US company of the week is Nike. John, do you want to start us off with favourite of the show, Tesco?
Yes, and one that I used to own and regrettably sold. So for anybody who doesn't know, it's the biggest UK supermarket and it's got a 28% market share. They had a Q1 trading statement out last week with like-for-like sales growing 4.6% to £16.4 billion in the first quarter, excluding fuel. And that included growth of 5.1% in the biggest region, the UK, where its market share rose 0.44 percentage points to 28%. In Central Europe, growth across all regions was driven by a strong performance in food, which helped like-for-like sales grow by 4.4%. Wholesale Booker saw like-for-like sales growth of 2%. A stronger growth in retail and catering more than offset the continued decline in tobacco and the food logistics. Tesco's reiterated its full-year underlying operating profit guidance of between £2.7 and £3 billion, and free cash flow is expected to fall within the medium-term guidance of between £1.4 and £1.8 billion. Around £400 million of the ongoing £1.45 billion share buyback has been executed, with the remainder to complete by April 2026, and the shares were up around 1.7% in early trading. In terms of valuation, Tesco's has a market cap of £26 billion and trades at 14 times forward earnings compared to the 10-year average of 12.6, and it has a prospective dividend yield of 3.7%. I thought these results were really good. It's by far and away the best UK supermarket. It's the market leader with a market share of 28%. I think it operates at both ends of the market because it's been growing its finest range, but also given its scale, its size, and its efficiency, it's able to compete against the discounters right at the bottom of the market too. It's got a decent dividend alongside the share buyback, and I suppose the exciting growth story that was there 15 to 20 years ago when Tesco's was doing very well in the UK and then it had the failed expansion to the US and some other parts of the world too, including Thailand, that's all now gone. But since it's focused back on the core business, it's been doing really well. I suppose you wouldn't be investing for the same reasons that perhaps you were back then. But that being said, with the return of cash to shareholders in dividends and the share buybacks and its dominant position, I think you could do a lot worse. And I held Tesco's definitely through the bad times. And then when the recovery story had started, I did probably hold it for another 1 year, 18 months, but I think it's properly now come to fruition. And you are seeing that in the re-rating in the share multiple. Sam, what are your thoughts on Tesco's?
I think the statement's really good. I think it looks like an excellent year. I think that market share gain is really impressive because it was a point really where I didn't see how they could gain market share. I think they do well to hold on to it, and I still have that view. But yeah, 28%, just fantastic. Only real complaint, I don't think there's anything in the results you can really knock. It's just a valuation now. I think I'd probably gotten used to seeing it at 10 or 11 times earnings, and I think that was pretty fair for a company with what I would consider to be not fantastic growth prospects. I think to pay 14 with a prospective yield of 3.7% when you can get that in a bank account, and I don't think you're going to get much capital growth from this. I just think fantastic business, fantastic set of results, but I just wouldn't be comfortable paying 14 times earnings for it.
Fair enough.
Sainsbury's is 12.5. Last time we covered Sainsbury's, I think they were putting up pretty similar results. And I think they're similar enough that I'd rather pay sort of 12.5 for Sainsbury's. I appreciate Tesco is a slightly better business, but I just think when neither of them have fantastic growth prospects.
Yeah, agree. How are Safestore doing?
Pretty well. So for anyone who's not familiar with Safestore, they are the biggest self-storage company in the UK. and they have come out with their half-year results for the year ended 30 April 2025. Revenue was up 2.8% to 111.5 million. And of that, storage revenue was up 2.5% to 94 million, and ancillary revenue was up 4.2% to 17.5 million. Underlying EBITDA was down 0.9% to 66.2 million, and closing occupancy was up 0.6% to 78.2%, and the average storage rate in terms of pound per square foot was up 0.8% to £30.40. The free cash flow was down 12% to 36.1 million. The operating profit was down 39.4% to 112.9 million. The diluted earnings per share were down 49.5% to 36.1p, and the dividend per share was up 1% to 10.1p. Net cash flow from operating activities was down 9.3% to 41.2 million, and the basic net assets per share was up 11% to 1.038 billion. So of that revenue growth, there was 1.6% like-for-like revenue growth in the UK, 0.8% in Paris, and 17% in expansion markets, which I'll cover a bit more later on. Administration costs increased 25% or 1.9 million due to the normalisation of head office staff incentives and the write-off of preliminary costs for discontinued development projects. Interest expense was up 3.3 million year over year to 13 million due to increased borrowings to finance continued expansion of the asset base, less savings from active debt management. And the group loan to value ratio is 27.4%, and that was up slightly from 25.7%. And the interest cover ratio is down from 5x to 3.9x. There was a growth in the maximum letting area, plus 11% year over year to 9.1 million square feet. They've opened 10 new stores and 1 extension in the first half, and they've added 531,000 square feet since the 2024 financial year. They've also entered into a joint venture with Nuveen to acquire the EasyBox self-storage in Italy, and EasyBox owns 11 stores with 1 in development, a total of 780,000 square feet. This follows the group's strategy of entering high potential markets with low level supply or alongside partners. Safestore will operate the stores, leveraging their capabilities and existing platform. And if we go to the expansion markets, in Spain, like-for-like revenue grew 28.6% year over year, driven by improvements in occupancy, closing at 62% versus 56% a year ago, and rental rates grew by 4%. In the Netherlands, like-for-like revenue growth was 10%, driven by increased rental rates and closing occupancy, 3.7% higher than the first half last year. Like-for-like revenue in Belgium grew 13%, driven by increased rental rates. New stores and expansions contributed an additional 1.1 million in non-like-for-like revenue in the half, largely through new openings in Spain. So following the announcement of the results, the stock was up 3%, and the business now trades at a P ratio of 16.6 and has a yield of 4.3%. I thought these results were pretty good. I think the revenue increase is positive. The overseas expansion seems to be doing well. That is coming at the cost of higher debt and a higher loan to value. But I think, the interest cover and stuff like that looks fine. I know some of the operating metrics and the earnings were down, but that's because they are spending money expanding the capacity. So I think really sort of the key thing to focus on is the revenue. I think the strategy seems pretty smart. I don't think there's really a huge amount of brand loyalty. So I think if they're able to acquire these overseas ones at an attractive price, I think that's fine. It's not like, for example, Tesco, who we've just covered, where when they've gone into overseas markets, they need to get people interested in like the Tesco brand, and they need to get them shopping there over, say, a Walmart, which is quite difficult. I think when it comes to storage, if you're already storing something somewhere and someone else takes it over, it makes no difference to you. So I think I think it's a business that goes well with European expansion. So yeah, I do quite like it. I think it's 16.5 times earnings. I think given the value of the assets, you probably would expect it to be a bit on the pricey side anyway, because obviously in terms of that price to book, you've got these assets that you could sell and a lot of value is in the balance sheet. But yeah, I think it's a decent set of results, and I think the business seems to be doing pretty well. What about you, John?
Yeah, no, I would largely agree with you. I think Tritax is also attractive. I'm not sure the latest price that's trading at, but I think there are a few in the sector that are appealing, certainly.
Would you ever have it on your watch list?
Potentially. I did have Tritax for a time, and I'm not sure. I feel like it's just sort of slipped off there. But yeah, I think they are. I suppose not that they're the same industry at all, but I did buy the supermarket income REIT, and perhaps that sort of just diverted me away from those a little bit more because I feel like I've got some exposure to that type of sector.
It's got big yellow share prices because we've not done that one for a number of years, but that's probably the most direct comparison. Yeah, that's at P of 17, so it looks pretty similar. And I think, if they're a similar valuation, I'd probably just rather own Safestore than Big Yellow, which I think is what we said the last time we covered Big Yellow. So maybe we don't need to refresh that, actually.
No.
Seems like nothing's changed.
No, fair enough.
So should we move on to Carnival then?
Yes, so we've covered it quite a few times on the show. It's interesting to just cover the industry and the sector. But for anyone who doesn't know, Carnival is a cruise operator, owns a number of big brands, has the Carnival Cruise Line, Princess Cruises, Holland America Line, Seabourn, Cunard, Costa Cruises, and P&O, which is possibly the biggest or one of the biggest names in the UK. They had their Q2 results out last week, with second quarter revenue increasing by 9.5% to $6.3 billion, driven by an uplift in both ticket sales and onboard revenue. Underlying cash profit, EBITDA, was up 26% to $1.5 billion, guidance $1.3 billion, and the uplift reflected strong pricing and prudent cost control. Free cash flow more than doubled to $1.5 billion, reflecting improved operational performance and lower levels of capital expenditure. And net debt came in at $25.1 billion, down from $26.3 billion at the year end. Looking to the rest of the year, occupancy is at near record levels, with pricing at all-time highs. Carnival increased its EBITDA guidance for the full year from $6.7 to $6.9 billion, and the shares were up nearly 13% in afternoon trading. In terms of valuation, Carnival has a market cap of £23.4 billion and trades at 1.1 times forward price to book, compared with a 10-year average of 1.3. And we'll come on to it, but unsurprisingly, it doesn't pay a dividend. I mean, on the surface, very decent set of results, but it's a horrible industry. It was smashed during COVID, and as a result, I mean, it probably would have a decent amount of debt anyway, but it has a mountain of debt from that. In terms of exactly how much it has, it's currently net debt of around $25.1 billion, and that's at 3.6 times expected underlying cash profits. It's very high. And to be honest, I think as an industry, it's something that's very capital intensive. It's subject to a lot of volatility with the trends and whether cruising is in vogue or not. It's one that I would just be staying away. I don't think it's investable. I think they're doing a good job despite everything against them, but it's one I'm staying well clear of. Sam, what are your thoughts on Carnival and these results?
Pretty similar. I think they've done a very good job with the net debt, in fairness. So 3.7x, but it's down from 4.1x a year ago, and then kind of 4.6x not too long before that. I think they're maybe getting to a point where you look at the net debt and it's like they might not actually go bust from it. But even once they have finished paying that off, it's still not a very attractive industry to be in anyway. So yeah, I just don't see why you would want to own it. It's just not an industry I want any exposure to whatsoever. I think it's up there with airlines in terms of probably the worst industries to invest in. So yeah, just totally uninvestable for me.
Okay. What about one that you liked historically, Moonpig?
Yes. So Moonpig have come out with their full year results, and revenue is up 2.6% to $350.1 million. Gross profit is up 3% to $208.6 million, and the gross profit margin's up 0.2 percentage points to 59.6%. The adjusted EBITDA margin is down 0.4 percentage points to 27.6%. Reported profit before tax is down 93.6% to 3 million, and adjusted profit before tax is up 16% to 67.5 million. So the reason the reported and the adjusted are so different is because there's been a big impairment. Adjusted earnings per share, that was up 18.1% to 15p a share, and the dividend, well, they've now started a dividend, and for the year it was 3p a share. The free cash flow was up 8.4% to 66.1 million. And the Moonpig brand itself grew at 8.6% year on year. They've completed a share buyback of 25 million, and they intend to repurchase a further 60 million during the financial year 2026. That's on a market cap of 728 million. So that gives basically an 8% buyback yield. And it looks like basically all the free cash flow will be going into the buyback because it's 60 million and free cash flow for the year was 66 million. So it is actually, they could do that 8% yield every year if everything else stayed the same, which I think is actually pretty attractive numbers we're looking at. Operationally, Moonpig and Greets active customers. So Greets, for anyone who's not familiar, Greets is the Dutch equivalent of Moonpig. So Moonpig and Greets active customers grew to 12 million, up from 11.5 million a year ago, with both brands increasing their customer base in the second half. Total orders grew by 4.1%, with average order value rising by 2.1%. Greets revenue decrease moderated to negative 4.7% in the 2025 year, or negative 2.4% on a constant currency basis, as we leverage the technology platform. Since April 25, revenue has been in line with prior year levels, also at constant currency. We're taking proactive steps to reposition the experiences proposition against a challenging market environment. 2025 first half non-cash goodwill impairment charge for experiences at 56.7 million, classified as an adjusted item. We expect to make continued strategic progress across the year ahead, helped by a strengthened divisional management team. The rollout of new features enabled the completion of replatforming during the 2025 year, and a strong pipeline of product launches in subscription, gifting, casual dining, and live experiences. The database of customer occasion reminders grew to 101 million, and that's up from 90 million a year ago. And the use of creative features increased by 45% year on year to 15 million. Moonpig Plus and Greets Plus subscriptions increased to 920,000 members, up from 540,000 a year ago, with Moonpig Plus lifting members' average order frequency by over 20%. In terms of outlook, they expect group adjusted EBITDA to grow at mid-single digit percentage rate and growth in adjusted earnings per share to be between 8 and 12%, with continued strong free cash flow generation funding ongoing investment in our growth strategy and consistent returns to shareholders. They have commented further in the business review that the Moonpig brand has a 70% UK market share for online single cards and around 65% in the Netherlands through Greets. And the online card market is still in its infancy, with only 6% penetration by volume and 15% by value in the UK. I'm surprised how low that figure is. Growth is driven by 3 compounding levers: more active customers, higher purchase frequency, and rising average order value, particularly through gift attachment. We continue to pursue our strategy of self-funded international expansion in Ireland, Australia, and the US, with combined revenue from these markets growing by 36.1% to 11.8 million. Ireland has reached profitability in its second full financial year of operation, and while still small, continues to grow steadily, validating our phased approach. In Australia and the US, which are at an earlier stage of development, I do like this strategy. I like firstly that it's self-funded, and I like secondly that they're building up slowly. And it seems, from reading it, the impression I get is that if it doesn't work, they're willing to just ditch it. They're not going to pump loads and loads of money into it if it's not taking off, which I think from a shareholder point of view is good, because you've got the potential upside, but they're not going to throw bad money after good. And they've also commented on AI, and they've said, we now use the latest AI models to tag our cards, to better understand customer search queries, to scan the image of each card, and to analyse customer sentiment by scanning the message in each card. In December, we launched Your Personal Handwriting, enabling customers to upload and apply their handwriting as a custom font, while in February we introduced AI stickers, allowing users to generate bespoke images via natural language prompts, with over 4 million created today. I do think one opportunity, if they could get an AI system that was good enough, would be if they could get some kind of picture generator where it's like you put in the picture of the person whose birthday it is and you describe kind of the scenario you want them in. You can probably create a lot more funny ones with that, but I'm sure someone inside the organisation has also considered that. In terms of a bit more detail in terms of Greets. So since Moonpig acquired Greets has probably, it's fair to say, underperformed. I've had a look why, and it is quite difficult to see because Moonpig's doing well in the UK and they're both dominant in their markets, but apparently Greece has been negatively impacted by poorer service from Dutch postal operators, which the internet seems to think are even worse than Royal Mail. That's impacted customer satisfaction, and Greece, while a market leader in the Netherlands, has not matched Moonpig's pace of innovation or customer loyalty. And also the experiences division, they've so far put it down to like more macro and economic stuff. I'd probably be inclined to agree because you think that adding on experiences and stuff and gifts and stuff to the cards, it just seems like a natural thing to do. So longer term, I would think that had a good chance of being successful, which kind of makes me think again in terms of that impairment. It wouldn't surprise me if the experiences did make a comeback because it just seems like something you'd expect to be successful longer term because it does naturally seem to complement it. In terms of the valuation, the business trades at a P ratio of 14.7 and has a yield of 1.36%. I actually think these are a really good set of results. I like the way the business is being run. I like the strategy. I also think that international expansion, I think, is potentially quite interesting. And I think they could actually, the penetration's a lot lower than I assumed as well. I think it's a business that is probably good enough to go on my watch list now. I don't think I'm at a point where I want to buy it, but I think it is a business I'd like to keep an eye on because I actually think it's a surprisingly high quality business. And it seems like it still potentially has quite a lot of room to grow. What do you think, John?
Yeah, it's something like the right move of the card market. I would say that in both UK and in the Netherlands. I do like the add-ons. I think that is where you might see quite a lot of the revenue growth coming from. And I'd recently purchased Moonpig card for a friend, and then the add-ons were super easy and very tempting. And they take payment, Apple Pay is very, very slick. I think the point you made about how AI might integrate, again, for the customizable card market, I think it's ideal. And I'm sure they could get one of the big models, whether it's ChatGPT, and utilize that in their product. I suppose it's getting it slick enough to actually roll that out, but I'm sure they'll be thinking about it and planning to do that sort of thing. So yeah, I think it's actually a very good business. I don't think 14 times earnings is outrageous by any stretch, and I think there's a lot of room for growth. So I do like it.
I think as well, like you can list kind of literally 4 or 5 growth avenues for it. You've got the international expansion, you've got the low penetration generally, you've got the experiences side of the business, you've got the AI as well. So yeah, it's a business I think I'd probably underestimated when it first became listed. I'll see how the shares have done since it listed, actually. It's done pretty poorly. It's still well below the IPO price, I think. So it listed at over £4 a share, and it's only £2.20 at the minute. Although it's come from looks like it had a low at near £1 a share. Yeah, it's not done very well since listing, but I suppose a lot of them don't in the first few years.
Yeah, no, absolutely. Okay, shall we move on to Bunzl?
Absolutely. How are Bunzl doing? I think it's been a while since we've covered them.
It has been a while. So in terms of Bunzl, for anyone who doesn't know, we have covered it before, but it's a British multinational distribution and outsourcer based in London, but most of its business is elsewhere. Some of the core aspects of the business involve distributing non-food products, supplying caterers, packaging, hygiene, safety, and healthcare items. They handle outsourced logistics with warehousing, delivery, digital ordering platforms, and inventory management. And they have their own manufacturing with private label lines like hand detergents, etc. And that makes up around 28% of that overall revenue. Roughly 29% of the revenue is food service, 25.4% grocery, 15.8% catering, and 10.4% catering and hygiene, 8% retail, and 6.5% healthcare. As I mentioned earlier, it's interesting, only 12% of the group revenue actually comes from the UK and Ireland. North America makes up around 40%, and then the France, Netherlands, Australia, and Brazil a further 38%, and then the rest is just rest of the world. Anyway, that being said, they had a trading statement out last week with first half trading showing revenue expected to increase around 4%, ignoring exchange rates, driven by acquisitions and disposals. Underlying revenue is expected to be broadly flat, and the consensus had been a 0.9% decline, with a decline in underlying operating profits. Bunzl reiterated its full-year guidance, with underlying revenue expected to remain flat against the consensus of 0.5% decline, and its operating margin to be just under 8%. The consensus was 7.7%. The group highlighted its acquisition of Solapac, a Brazilian distributor of own-brand packaging solutions for the food industry, which is pending regulatory approval. And the shares are up nearly 2% in early trading. In terms of valuation, Bunzl has a market cap of £7.6 billion and trades at 12.8 times forward earnings, compared with the 10-year average of 17.8, and it has a prospective dividend yield of 3.3%. I think these results were better than the difficult set they'd had for Q1, with a strategy of price rises at a time of deflation, upsetting key customers, and ultimately they had a 0.9% revenue decline and pressure on the margins. Margins are expected to be sub 8% this year. I think this statement, perhaps things aren't as bad as the market was expecting on the back of that. That being said, I don't know, it's a fairly defensive business. Geographically, it's well diversified. It does have the strong distribution networks and relatively capital light, i.e. they are avoiding a lot of their hefty manufacturing costs. But I think growth, and this is where I would sort of lose interest and what would put me off Bunzl, it's mostly just been through acquisitions. They seem to be doing a reasonable job of that, but I think I would look at some far better businesses, even down in this sort of valuation pool. And I'd be thinking about something like maybe B&M, different sector, but that has an uncommanding valuation, and I think potentially quite a lot more growth ahead of it. So for me, I guess there's opportunity cost in there, and I'd be looking elsewhere for something that could deliver true sort of organic growth.
I would agree. It's not an industry I'd be hugely interested in. It's a business I struggle to visualize. They've obviously built out a fantastic distribution network. They're clearly very good at what they do, but the model just makes me a bit uncomfortable when you look at, they've just made literally hundreds and hundreds of acquisitions, and it's just not a business that I necessarily easily understand in terms of, I guess, what the USP is. I suppose with distribution, it's mainly scale, isn't it? Because that allows you to do it at cost, and that is the market. It's just a lot of people just want the lowest cost distributor. But yeah, it's not a business I easily understand. I'm not hugely attracted to the strategy, although it's worked very well for them. And yeah, it's not a business that particularly interests me. It doesn't seem like anything's changed since we last covered it.
On to one that you own, Nike.
Yes, I am now. I think it's the first time we've covered it. I'm now a shareholder, apart from when I first bought it. Nike have come out with their Q4 and full year results. We'll start with the fourth quarter and then we'll do the year as a whole. So for the fourth quarter, revenues were down 12%. The Nike brand specifically was down 11%, and that was driven by declines across all geographies. Nike direct revenue was down 14%, and that was due to a 26% decrease in Nike brand digital, partly offset by a 2% increase in Nike-owned stores. Wholesale revenue for the quarter was down 9%. Revenues for Converse were down 26% due to declines across all territories. Gross margin decreased 440 basis points to 40.3%, primarily due to higher discounts and changes in channel mix. Selling and administration expenses increased 1%, and the main one was demand creation expense, which is marketing, and that was up 15%, primarily due to higher sports marketing expense and higher brand marketing expense. Net income was 0.2 billion, down 86%. Diluted earnings per share were down 86% as well. For the year, revenues were down 10% on a reported basis, 9% currency neutral. Revenues for the Nike brand were down 9%, and that was driven by declines across all geographies. Nike direct revenue was down 13% on reported basis. due to a 20% decrease in Nike brand digital, while Nike-owned stores were flat. Wholesale revenue was down 7%. Converse revenues were down 19%. Gross margin decreased 190 basis points to 42.7%, primarily due to higher discounts, changes in channel mix, and higher inventory obsolescence reserves, partially offset by lower product costs. Selling and administrative expenses decreased 3%, and marketing was up 9%. Net income for the year was down 44%, and diluted earnings per share was down 42%. Inventories were flat, and cash and equivalents were down $2.4 billion to $9.2 billion, as cash generated from operations was more than offset by share repurchases, cash dividends, bond repayments, and capital expenditures. So following these results, Nike actually had its best ever day as a listed company. It was up about 18% in a day. Slightly surprising because the results are terrible. I think the expectations were so low that somehow this is less disappointing than the market expected. Nike CEO Elliot Hill, he came in October 2024 after the previous CEO retired. He's not had a great, he's had a pretty rough first 8 months, hasn't he? But he's been with the company over 32 years, started as an intern in 1988. His last role, so he actually retired in 2020. So I think they brought him out of retirement to do this. But yeah, he had been at the company for 32 years. His last role before retiring was he oversaw all commercial and marketing opportunities for Nike and the Jordan brand, managing the P&L across 4 geographies and helping the business grow to over $39 billion. He has already been over his turnaround strategy, but he wants to refocus on sport. And he said that Nike has lost its obsession with sport. So that's partly why the marketing and the sports marketing expense has gone up. He wants to restructure marketing so that it's more performance marketing, and he aims to create more inspiring stories that connect with consumers. He wants to rebuild wholesale relationships. So I think he kind of wants to go back to the roots, really, of just being focused on being a sports company. I think the strategy sounds pretty sensible. And he did say, as part of this report, moving forward, we expect our business to improve as a result of the progress we're making through our win now actions. I don't know whether that small nugget is enough to justify the reaction. Yeah, as a shareholder, I mean, these results are terrible. I knew that when I bought the shares. That's why they were so cheap. I am surprised by the market reaction. Maybe it's just a short squeeze, actually. That would make a lot of sense. But I certainly don't think the results justify the reaction, but I'll take it as a shareholder. But it wouldn't surprise me if a lot of that is then given back before the next set of results. But the Nike brand is so good that I think someone's going to solve his problems. I don't think it's going to take too long. I don't have any reason to believe Elliot Hill isn't the person to do it, and I think he's got an excellent track record. So hopefully this will be the last year we see like this, and the turnaround strategy will start to bear fruit over the next year. John, as someone who's less biased, what do you think? I mean, it's not much positive to say about the results, but what do you think about the results in the business?
I suppose, results disappointing, but to be expected and priced in. Well, yeah, to a degree priced in. I think you've got such a high quality brand underneath that on that basis, you can make an argument for the shares. Purely on the numbers, you can't. But I think that's why you bought and took a position in Nike. And I would expect it to do well in the long term. But how long the turnaround takes, I suppose that's the big question.
I think I forgot to give the valuation for Nike. No, that's my fault. I got distracted. It's not going to change your opinion anyway, but yeah, I'm sure the listeners would like to know. So it trades at a P of 33, has a dividend yield of 2.22%, and it trades at 20 times free cash flow. So it is now more expensive than when I bought it, but that's obviously because these results have come out. But if you look at it on normalized, it's very, very cheap. But yeah, I don't think that really changes anything you've said anyway.
So of the companies this week, what would be your top pick and what would come last?
I think, although I've recently bought it, I don't feel like I can put Nike as top pick, given how bad those results were. I think I'd have to put Moonpig at the top. Last, I think it would probably be Carnival because of the industry, although I'm not hugely keen on Bunzl, but Carnival is just uninvestable. What about you?
Yeah, it's a bit boring, but I would go for Moonpig. I think that's quite exciting, actually. And yeah, it would definitely be Carnival. I think that's sort of uninvestable. Bunzl would be the next bottom.
I think that's everything in that case.
Well, thank you very much for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.